Good morning, everyone. Um, I was looking at the topic investing beyond borders, and I think in this environment, India seems to be more stable right now. But I know very little about investing. I depend on advice. But yes, I think tactically a lot of stuff will happen because simple reason that the world is extremely interconnected right now over the years, but is now getting more and more fragmented geopolitically. So that combination leads to a lot of disruptions and a lot of change in strategy for producers, for consumers, and also for investors. I mean, I would presume. Uh, So what I'll do over the next few minutes is take you through India's journey, and also in the middle of all that is happening. I think just as a reminder, last year during April, close to similar period, I think there was a lot of fear that tariffs will squeeze the economy. But actually, India grew faster than what was expected. There are reasons for that. I think same reasons may not play out in this geopolitical environment. But the point is that there is some resilience in the system which allows you to withstand shocks to some extent, but more resilience than was there earlier. And I think if I look at the post-pandemic period, growth has surprised mostly on the upside. I think even last year was a case in point when I think despite the tariffs, India grew much faster. And now at least the government believes that our potential rate of growth is around 7%, which was 6.5 estimated by them about 3-4 years back. And this, I think one can correlate it to a number of things like building infrastructure, at least fast-pacing some of the reforms, deregulation. I think all these things do help over a period of time, and this is the lesson we learned in 1991. Now, what's going to happen this year is extremely hard to predict. I think the environment is very foggy, and I'll come to that in a minute why it is so complicated. RBI came out with 6.9% growth yesterday. Different people have different assumptions, and their growth numbers differ. But overall, I think the good news is that nobody is talking about growth below 6%. I mean, even in the worst case scenario, at least as of now, 6% is a pretty healthy rate of growth in this environment. Yeah, I think this chart is very useful to look at. I'll try to connect some dots as well. Look at the long-term trajectory in view of the current turmoil or the geopolitical shocks. So what you see is dots here in blue color, which is India's GDP growth for last 45 years. So there are 45 dots there. And below is the advanced countries as a group, their growth rate. And you can see growth is never straight line. It is always up and down. But the straight line passing through these growth rates is the trend line, the solid line that you see. And what you observe, particularly in the last 20 years or so, is the growth cycles, the short-term growth movements of India and advanced countries are pretty much synchronized. So whenever there is pain there, it transmits to us. And this is, I think, based on at least empirical evidence from last 20 years of data. So which essentially means any problem there will move to us as well. But the encouraging part is that doesn't disturb the long-term trajectory. The long-term trajectory for India is going up in terms of growth rates, and for advanced countries is going down over the last 4 decades or so. And the reason is also not hard to understand. Their aging, their productivity, etc. are going down. India, on the other hand, is starting from a very low per capita income base and has a lot of opportunity to push its growth up through by reforms, by building infrastructure and doing a number of things which these guys can't do. I mean, so, and if this India was not trending up, I would be extremely worried, because you will never come out of a low income trap. I mean, if you don't grow fast. So and if you focus on the post-pandemic period from this chart, the advanced countries also recovered pretty fast. I mean, they also grew above the trend. I think as you can see there. I think, yeah, this one. And if you look at India, India is growing a little above the trend. I think that's why that prompted the government to increase the growth potential. So this, I think, chart helps. So long-term trajectory depends on a number of factors. Short-term depends on a number of shocks, which we don't have control over. And so one should be prepared for ups and downs in the near term. That may not necessarily derail your long-term. As far as the global growth is concerned, US is exceptional in many ways, even in terms of growth. But its growth is highly concentrated in investments and investments in AI-related infrastructure, which is kind of creating an upside to growth. I think the data center growth in US is phenomenal. I mean, and this is benefiting all the countries which also produce inputs for the US data centers, whether it is in Asia or even some parts of Europe, etc. Rest of the world, I think, is slowing down. And I think whether it is Eurozone suffering from high gas prices, they're very sensitive to that, or it is China, it also finds it difficult to sustain high growth, and the world economy as a whole. I think the projection right now is a gradual decline from everybody. Now, coming to geopolitics. So last year we saw tariff hikes, unilateral tariff hikes, and the uncertainty as measured by the Global Uncertainty Index, I think it was at the highest level that we have ever seen, I think, since the index was created. It was higher than during the COVID period. It was higher than during global financial crisis. And reason was, there was a way in which things were done, and suddenly that got reversed. I think the world had got used to the Washington consensus, where I think the rules-based systems applied, where things were predictable in many ways. I think all that got dislodged, so you became certainly uncertain. That was coming down because tariffs did come down, but now the Middle East conflict is the largest energy shock on record, according to our S&P's vice chairman, who's also one of the top leaders in energy market, Daniel Yergin. I think he's and many agree that this is the largest energy shock in record, because Hormuz was never closed before this. I think that makes it a very, very unique event. Yeah. Now, I think I just want to take a moment to tell you what happened last year, because that has implications for this year also. Why did the tariffs not impact us, and why this crisis is a little different from the tariff. So number one, the tariffs were announced, but a lot of exemptions were also given. I think if you look at India's exports, if you take electronics out, suddenly the exports become very weak, quite weak. But with electronics, which had exemptions, the exports were surging. Half of our exports are in services. They've done well, so that also helped you. Then countries front loaded, because they became very. It was very obvious that the quicker you export before August, the tariffs were coming into play in August, the reciprocal tariffs. So before that, everybody was rushing to export. And then finally, we managed to diversify our exports in areas which looked extremely difficult, like seafood, for instance. We have 5.5 billion worth of exports of shrimps from India, and a large part of that goes to US, but you managed to sell it to other destinations. So a perishable product you were able to diversify very quickly. So newer things we are learning, I mean, as it happens. Now coming to, so this was one reason why we were not impacted, but the push to growth up came from a couple of things. One is good luck, which is from low crude prices, and also from normal monsoons. Now, low crude prices is not an option for this year. I think even RBI is working with 85. It was supposed to be 60 this year. That was the forecast. The normal monsoons, I think even the central bank highlighted, everybody has been highlighting that there is an El Nino kind of phenomena which can have an impact on agriculture production. So good luck is not from that side, is because these things we don't control. You don't control rains, you don't control crude prices. Then I think the buffers, some of the buffers are very much there. For instance, I think we have ample food grain stocks. That's a buffer. We have healthy balance sheets of the corporates and even the banks, so to say. That helps. Current account deficit is still low, but is now increasing with the rising price of crude. And then policy levers were also favorable. I think we were cutting rates last year. This time, I don't think anybody is forecasting rate cuts from the central bank. We might see rate hikes. I mean, if inflation goes out of the central bank's tolerance limit. Government has spent a lot of money in direct benefit transfers, which is phenomenal amount of money. It's more than the food subsidy bill, which was the money given to women. All that supports consumption. GST rate cut, income tax, all that supports consumption. So this growth did not come from the thin air. It came from the muted impact of tariff plus the support. So not everything that helped us last year is going to help us this year. I think we still have our strengths and resilience, but not everything is going to be that favorable. Okay. Now, I think it's how do you understand what's going on in the West Asia? So first, I think when the crisis started, it was a kind of a flow shock. Suddenly, Strait of Hormuz is closed, and you're not getting oil from passing through that. And for a country like India, I think, or even for Japan for that matter, I think that was the sudden stop in the flow of energy. And what helps during such times is inventories, because some have inventories lying on the sea, some have it. So all that gets exhausted pretty quickly. But during that phase, it's not seen as very disruptive. It's seen as transitory impact on macros. Slowly, when the crisis became deeper and started expanding, I think to the other countries in GCCs where facilities for production of oil, gas, I think they were getting damaged. Then the story started changing. The strategic reserves come into play at that time, whether you have it or you don't have it, because the inventories are gone. India also would have used some of its strategic reserves because it was 74 days. Now it is around 60. So it has probably been used. At that juncture, the markets began to fragment because they're not completely repricing it, but they began to fragment. Money moves out from emerging markets towards safe haven assets, which is playing out even today. I think the US dollar is strengthening. All those things begin to happen. So that is when you start getting really worried. And then I think the third stage is the shock to the market, where markets started repricing all the stuff that is in their domain, and so value of everything gets repriced. And this, for instance, happened during COVID. If you remember, there was a synchronized decline across the globe. I think no market was moving up. Till now, we have seen fragmented, somewhere I think tactically capital is moving from one part to the other. But when the total market shock takes place, then I think this is what you're trying to avoid, a synchronized decline in the markets everywhere. And so this leads to a broad-based slowdown. It can lead to a recession. I think that is why the efforts at negotiations, efforts at reducing the conflict become very critical. As I said, I think this is in the nature of a poly crisis. I mean, it's not one oil price shock. It's got many elements. So I think it's an energy shock. It's a trade shock because we also export quite a lot to GCC and we import from there. It's a freight cost shock. Suddenly they have gone up. You have to pay $2 million for every ship that passes via Strait of Hormuz. That's a cost added. And India gets 40% of its remittances from Middle East. So far, no crisis has impacted remittance income. But this is physical destruction. People might decide to, if this intensifies, they might decide to come back. And so temporary impact on remittance cannot be completely ruled out. And I think I'm a little worried about manufacturing if this continues. Although there is a truce, but I think we've seen that we can't take it on face value at this juncture. I think you need to see a solid negotiation play out. Manufacturing, in GDP, manufacturing turned out to be the fastest growing element in the last 3 years, growing at 11% per year. And that it gets impacted because the lubrication for economic machinery or machinery of manufacturing, I think, is oil. Without that, things don't move. So manufacturing, we've seen it in parts, Morbi, tiles, ceramics for that matter. I think there are various others, fertilizers where it's a feedstock. I think that gets impacted. So, and capital flows, which we talked about, the safe haven movement, the people still prefer the US dollar. And then overall uncertainty, decisions will get postponed. I mean, that is for sure. We have buffers, but buffers also keep eroding. They can't. It's like a tide. I think you keep getting attacked more and more by the tide. I think your both buffers that you have, I think they become weaker, and I think strategic petroleum reserves shrink. Alternate sources of energy supply are not so easy to come by when everybody is scouting for the same resource, and the corporate balance sheets healthy, I think, does help. I think they can withstand the crisis. And then fiscal space is very critical. Monetary space is not there, but fiscal space is not there to that extent that we can unleash a complete offset of what is coming at us. So I think this is a very complex set of events that is happening, and they all have interlinkages with each other. So it becomes difficult to monitor. So you have to look at sector by sector. I mean, which sector is linked to gas, which is linked to oil, which is linked to freight. So I think some of them are interlinked. So it's a very complex phenomena that is playing out. And here I think the global environment in general, it's not the geopolitics alone. It's just that the bigger pain has come, so we have pushed the other pain on the sidelines. I think there are a lot of vulnerabilities in the global economy which are being masked by extremely high growth. The high growth is led by your AI-related investments, I think, which are betting on very, very high returns in future, which may or may not come through. I mean, who knows? And then Middle East uncertainties on top of that, because it's the key risk. So you're focused on that risk. And I think it is a risk for growth. It is a risk for inflation. It is a risk for external current account deficit. I think if it is not resolved in time, I think these things will expand. As I said, from a flow shock to a market shock, I think that journey gets completed when this crisis expands. Don't forget, fiscal situation across the world is extremely bad. Very high level of debt, and this is not a good scenario to be in. I mean, so that also can have spillover effects across countries, which can flow beyond boundaries of the country where they are originating from. Which is it could be in US, it could be many other, and every country will have to spend more now. I think US will spend more on defense, so there will be more pressure on the deficit side. Then we also have technological disruption, which is also seen as an opportunity, but after humming in the background for almost 50-60 years, now you're seeing a nonlinear movement in AI, and I think we are still trying to grapple how to adopt it. But it will cause disruption in several job markets, and I think in our growth engines also. So I think that don't forget about that disruption, which is also simultaneously brewing. And then finally, I think climate change, it's a risk for the portfolio also. I think that you hold, depending on whether you hold the climatically vulnerable portfolio. But for India, I think as a whole, about roughly the vulnerability is largely in agriculture, and it can transmit to other parts as well. We are the 7th most vulnerable country from a climate perspective, and we have a world's largest populated. So you have fertilizer shock playing out. On top of that, the climate is also expected. So it can be a little messy story if it does play out. Nobody knows how it's going to play out. But overall, I think I'm ending with a slightly pessimistic note because that's what is visible to you. But despite that, I think we'll still do reasonably well. I think that is the hope, unless it morphs into a full-blown polycrisis, which is the third case that I pointed out. So I think with that, let me end my presentation. The point I wanted to make is that it's a situation which we have not seen. I think geopolitics was like your tariffs walls were coming down when everybody was growing. Every country was smoking their way to growth, including China. Nobody was worried about climate. And AI was not seen as the kind of disruption that it is seen now, both an opportunity and a disruption. So I think these three things are very different from the growth environment which Asian countries faced. So you're facing a completely different. I'm not saying it's going to stall you, but all I'm saying is you'll need a different playbook to come out of this. Thank you very much.